Dude, welcome to the stream. I've honestly been a fan of yours for a while. I think that myself and my audience definitely sits more on the in the weeds crypto side, but obviously everything you
Hmm.
talk about macro wise especially affects everything that we do. And I think some of the more prominent crypto people, like the Ape Woods of the world, like the Ansems of the world, speak really highly of you. And
Hmm.
so I'm happy to have you on the stream, man.
Well, I mean, I think it's a good audience to get exposed to, and I'm definitely not an in the weeds crypto guy. I'm familiar with it a little bit. I wrote a novel that has a kind of blockchain uh, interest to it called Quaz. It's a kind of a financial thriller thing. And so I've researched it. I've dug into it. I haven't owned a lot of like different altcoins or played that space. I wish I had because it's been an incredible investment vehicle. And traditionally I've kind of looked at things like, okay, there's Bitcoin, there's altcoins, but I think that the TradFi world is in the midst of a major kind of shift where it's starting to look at some of these other coins in a different way. Maybe it was Tom Lee coming out with his ETH treasury company a few weeks ago, but I think that's just the beginning of it. I think the Genius Act was the first act of a three-act play. Cynthia Loomis has talked about it, that it starts with a stablecoin bill. The second move is going to be regulatory clarity. And the third thing is going to be an incorporation of some of these coins into a strategic reserve. And so we're on that pathway. And I think like if alt season people thought that's not going to happen or whatever, I think that's just getting ramped up. I think ETH's going to blow past 4,000, and I think a bunch of other things are going. And I bought my first altcoins ever in the last month, like ARB, which is an L2 Ethereum coin that Robinhood is doing its chain stuff with. They talked about that even they're going to come out with their own chain, and it's going to be based on ARB, ETH, Sol. I haven't gotten much beyond that, but to talk about the bigger macro picture, how that fits into crypto, how that fits into everything, happy to get into anything you want to get into.
What a fucking intro, man! Holy shit! Congrats. Oh, first of all, congrats. I actually had the one of the founders of Arbonne like 2 weeks ago, right after the Robinhood
Mhm.
announcement, which was pretty awesome. Yeah, what a
Yeah.
fucking intro. I mean, how would you describe what your primary focus in markets is? Like, what do you pay the most attention to?
Mhm. I think for me, so my background is like heavy duty kind of broker dealer, SEC FINRA stuff. So I've been the CEO of three different FINRA SEC broker dealers, SecFi Securities, Equity Securities, Vested Securities. We specialized all of those in essentially brokered sales of private equity. So we would be selling Airbnb or Uber before it was public, taking employee stock options and using, basically somewhat convoluted vehicles to sell those to hedge funds and accredited wealthy investors. So I really understand the private equity space, which is getting a lot more play now, with Robinhood talking about the AI or OpenAI, SpaceX stuff they did. Um, and then behind all of that is just a general investment background with some other stuff I did before that time. I worked for some large asset managers like Russell Investments out in Seattle. I got an MBA from Duke. So I've done all of this over those decades. I built up some wealth, some real estate, some different stuff. And essentially what I do now is I manage different wealth, and I wrote a book, and I like to talk to people and just get the word out about things, and continue to work in different spaces, and do some consulting, hedge funds and different speaking engagements. So my background really is just looking at this market. Now, what do I tend to focus on a lot is what's happening from a fiscal perspective, meaning what is the government doing? How does that impact things? And so I've been pretty good at reading things. I read the tariffs as kind of a scare point in the markets. I called out, that these would probably lead to a 15-20% decline, but that things were going to come back. Uh, Called like a 7,000 SPX call at the end of the year, even at the heart of everything collapsing. So I was like pounding the table on like April 7th, like this is buying opportunity of a generation for risk assets. Like Bitcoin was 79,000, SPX was 5,000. And I'm like, literally, like if people go back to that time frame on my X feed, I'm like, buy now. This is the buying opportunity of a generation. And I really believe it is. And I think this whole thing is just getting started because we're moving into a whole new paradigm. It's not the your grandfather or father's paradigm. Risk assets are going to go up. Fiat's going to continue to devalue. And then this whole tokenization theme is starting to flow into the ancillary crypto assets. And it's, in my opinion, really just getting started.
Man, you fire me up, and you did fucking nail the move on Twitter. I mean, I think since April up until now, I think there have been very few people that were as spot on as you. Can you talk to me about the process of building conviction to be able to be so confident in what you think is going to happen, like you did in that April move?
Yeah, and I did. I think I put like a Twitter article out like
Mm-hmm.
a week or two later. Like this thing's going higher and quicker than most people think. Like this is not, and there are so many people that doubted it. All the quote smart money. There was another post I put about institutionals now the dumb money. Like this, this is a paradigm shift, and it's not built upon like fundamental analysis. That I'm looking at companies and thinking P ratios are moderate. It's built upon, I would say, as I said, a paradigm shift in what the financial markets really are. The S&P 500 is in essence a quasi Ponzi scheme that now supports the United States government fiscal situation. Okay, if the S&P goes down 25-30% and stays down, those capital gain tax receipts get cut so severely that you then enter into a period of severely depreciated tax receipts that's going to force the government to print even more money. And so government policymakers, Scott Bessent, whoever the new Fed chair is going to be looking at this whole situation and saying, we can't let stock markets collapse. We can't let the bond market skyrocket out of control, because if we do, we're going to lose our whole tax base. We're going to have to print to get out of it, which is going to be even worse. And so the lesser of two evils, in my opinion, is, print money, inflation, do what you need to do, and try to grow your way out of it any way you can. And so they're trying to pump nominal growth any way they can. They're going to do what they need to do on the central banking side. I did like a thread just yesterday, just talking about the history of central banks and how they've always been created to fund the federal government. That this whole thing about monetary policy and full employment and price stability, these are things that were added on in recent decades. That if you go back to 1694, when the Bank of England was founded with William III, he was a sovereign who had basically gone bankrupt. He tried to finance a war with France, borrowed a bunch of money, couldn't pay it back. All the rich people in England said, we're not going to lend you any money. He said, well, how can I get money? And they said, okay, create a bank, call it the Bank of England, let us issue paper notes. We'll sell those notes essentially to the population, bring in their gold and silver. You take their gold and silver, we'll give it to you. You pay us an interest rate on it, and then you can build your ships and pay your soldiers and everything else. And this is the whole purpose of central banks. It's the same thing with the U.S. has had four central banks. The Bank of North America was founded by the Continental Congress. The first Bank of the United States existed 20 years. The second Bank of the United States ended by Andrew Jackson in 1836. And then the third central bank is the Federal Reserve. All of the purpose of those was to fund the government. The U.S. government used to literally take like $100 million in bonds, give it to Wall Street, take in like $60 million, and Wall Street would go sell it, and there'd be a 40% spread on it. And so the whole basis of the Federal Reserve is to fund the government. In the 1913 Federal Reserve Act, it lists three mandates for the Federal Open Market Committee. Federal Open Market Committee, price stability, full employment. That's the dual mandate everybody talks about. Nobody talks about the third mandate that is still in statute, which is to maintain moderate long-term interest rates. And so I think what Trump is doing, what Besson is doing, Kevin Hassert, all this brain trust, economic brain trust, is we're now going to move into a period where the Federal Reserve is going to get back to its knitting to finance the government. And that's why he wants low front end rates so that they can, push out a bunch of debt and T bills at the short end. They can fund it at low interest rates, and they can continue to expand the deficit or the debt to GDP, but keep interest expense low by keeping rates low. What that is that's just a recipe for financial asset inflation. And so, I'll stop in a second here, but I actually think a lot of people have talked about, well, there's this big spread between the haves and have nots, and it's getting out of control. I think there's at least one more big leg up of greater financial inequality, where the billionaires even become richer. But what's going to happen is there is going to be a trickle down, and there's going to be real wage growth. There's going to be a resurgence in manufacturing and all this stuff. But there's also going to be a massive explosion in financial asset prices. And those things need a home. And once equities get at 30 times, forward earnings, people are going to look for other things. And that's going to be Bitcoin, gold, and alts.
Can you explain what you mean by a new paradigm for risk assets and then what that means like for crypto?
Yeah. So I think the old paradigm was, and really back in the day, there used to be this thing called the discounted dividend model, where people would try to actually value stocks like trying to discount the dividend. Dividends are so small now. Like most companies, they'll do share buybacks. And so what's happening is, and this is a little bit MMT type stuff, modern monetary theory stuff. So when the federal government produces a deficit, that's essentially a private sector surplus. If there's a $2 trillion deficit, you can think about that as $2 trillion in the private sector that now needs to find a financial asset home. And so as deficits have been growing post-COVID and sustained at these high levels, like 6-7% deficit to GDP, there's this excess money. It just has to go somewhere. It has to find a home. Post-COVID, first home it found was real estate. Those prices got so high, we got mortgage rates up, people aren't plugging into that. Then it went into the stock market. Now it's saying, then I think it went into gold. And then it's going into Bitcoin. And then in just the last month or two, it's starting to go into crypto more generally. And so it's just money needs to find a home because the economic activity is sufficed at, basically equal to government expenditures. When you have a $2 trillion deficit, it's essentially plugging 2 trillion extra into the economy. If you think about it this way, like, okay, the money goes to Boeing. Boeing builds planes, or they build fighter jets, or Lockheed Martin, or something like that. But then where does that money go? Then it goes to the employees. And then where does that money go? Well, some of it they spend, maybe at a restaurant. Okay, but then where does it go? It goes to the restaurant owner. And then they don't have as much money to spend, or they don't spend as much money as they made. So then some of it has to go into savings. So inevitably, as the government increases its deficit levels to 6-7% of GDP deficits every year, it's just plugging in trillions of dollars that has to find a home. And at a certain point, equities are just going to look crazy, like 30 times PE. And then people are going to say, where else can I put it? And so the paradigm is that we're in an extended period of massive fiscal deficits. Those fiscal deficits are going to create private sector surpluses. Those private sector surpluses are going to create extra cash flow that's essentially savings that needs to go somewhere. Traditional financial instruments like homes and stock market are so full up on valuations that then people are going to look for other alternatives. And then that's essentially the niche that Bitcoin and crypto will fill.
I mean, I love to hear that. That's awesome. To follow up on, I think something you said in your first take, if assets aren't valued by fundamentals in this new paradigm, how do you assign value to assets?
Yeah. It becomes supply and demand. So you look at what is the supply of US equities and you think, okay, we've got corporates going to buy back another $1 trillion in US equities in the next 6 months, likely. And then you look at people that are essentially plugging 5, 10% of every paycheck into a 401k that's just demanding to purchase this. And the BlackRocks of the world are saying, wait a minute, we want to expand categories. We want to go into, private equity, essentially startup companies before they go public, your SpaceXs of the world. We want to expand into Bitcoin or crypto. And so financial advisors, 401k trustees, all of these people are saying, look, we've just got this flood of capital coming in. What are we supposed to do with it? Like, are we going to tell the people that have 10% of their paycheck, sorry, don't put it into the S&P 500 anymore because we think it's fully valued? No, they're going to take that money and they're going to put it into their mutual fund or their ETF. And eventually, active type managers, hedge funds, institutional managers, pension funds, they're going to say, wait a minute, like the S&P 500, okay, now it's at 22, 23 times forward earnings. Eventually, it's going to get to 28, 29 times forward earnings. And they're going to say, we need to diversify more. We need to put this money somewhere else. Where do we put it? Gold, platinum, silver, precious metals. Yes, that can absorb some of it. Bitcoin, yes, that can absorb some of it. And then they're also going to look for other avenues to essentially absorb this private sector largesse, which is the result of profligate fiscal spending, and it's just flooding into the economy, and it's just basic math. If and tariffs are not going to change that. So, really quick on tariffs, like people are saying, well, we did have a budget surplus actually last month in June, which is very rare. The monthly Treasury statement came out a few weeks ago. It showed a $27 billion surplus, meaning the U.S. government actually spent $27 billion less than it took in. And some of that is tariffs, but tariffs are not going to make up for a $2.1 trillion deficit. At most, we're probably going to be looking at like 300 billion in tariff revenue. Um, I could get into the calculations of how I get there, but it's going to be meaningful, but not extremely significant. And when you look at the one big beautiful bill, the capex spending depreciation, and then when you add in this whole thing that's going on with AI, which is a game changing industrial internet revolution type thing, once in a generation type thing. What I see happening is something like between 1997 and 2000, which is like a multi year crazy bubble where like the NASDAQ goes from like 1100 to 5,000. Now, I'm not saying the NASDAQ's going to go up 400%, but there's a lot of assets out there that are going to go up 400% in the next 2 or 3 years.
Well, um, that's a fun prediction. Do you think crypto is one of those asset classes that's going to be the beneficiary of just like do you think the proper bubble hasn't formed yet for crypto?
No, no. I think everything is just getting started. I think people have no idea. As long as you listen to the financial media and people still say it's time for the market to pull back or valuation, you'll know the true bubble has formed when everybody you listen to is like saying what I'm saying. when the average guy from JP Morgan or Morgan Stanley is saying we're in a new paradigm
Whoa.
and assets are going to go up. But as long as you still got these guys going out there saying, well, we're looking at valuations, we're not there yet. And at that point, then yes, there's going to be a time to pull back. And I always look at things in different time frames. I think short-term time frame, we're probably getting close to a point for a little bit of a pullback, but it is just going to be a little bit of a pullback ahead of another move. Maybe as ETH hits 4,000, maybe there's like a fail there that then sends a signal to other alts, and it's like, okay, take a break. If I take a look at where ETH is right now as we're talking, uh, I don't have it up on my screen, but it's got to be damn close to 4,000. What do we?
I
So
think
we
it's
got up to
30. Let's see.
39.42 today,
Yeah, we're 37.60 right now.
and now we're at 37.62.
Yeah.
Is what I have. So we got dang close to that 4,000 level, which I think is kind of a critical level,
Yeah.
and that's these could be like times for a little consolidation period or something. So I wouldn't be like, okay, take all your money today at this hour and throw it into alts because we're getting ready to skyrocket. I would say if you're looking at alts and you're thinking about when do I want to get into these things, that we're probably getting close to a short-term peak. There could be a lull, a pullback, and then that's when you're going to want to get in. Like if ETH tracks back to 35, 3,600 in the next, few days, we're getting back to these check back points.
Yeah,
I'd
yeah,
have to
yeah.
look closer at my charts to give you specific things. But essentially what I'm trying to say is like we started a whole breakout run. We're on that path. We're probably in like seventh, eighth inning of this leg, but this is not even the big leg. And we're going to hit the ninth inning soon, pull back a little bit, and then we're going to head into a whole nother leg that's going to be a lot higher. That's going to, take ETH at least to 5,000, Bitcoin to 150, and some of these other things, Sol 250, 300 probably, you know, things that I've got like ARB, I'm not sure. Bought it at 32. I think it's in the 40s. Probably going to hit a dollar. I think these things are going to happen in the next 12 months, but this would not be the day to, in my opinion, to
Yeah.
like totally jump into them. But I think medium to longer term, we're ready to move.
So at the beginning of the stream, you mentioned Tom Lee, and I'm curious from a macro TradFi perspective, how much of an impact has the immersion of these treasury companies had on TradFi's interest in crypto?
I think I think Tom Lee was almost secondary to Vlad Tenev's Robinhood announcement about blockchain equities, about 24 potential for 24/7
Yeah.
equity trading via the blockchain. And tokenization of securities is something that has been on TradFi's radar, and I think he's kind of pushing the envelope. But there's a company, DTCC, the Depository Trust and Clearing Corporation. This is essentially the clearing organization for like 80 to 90% of equities in the United States. If if you own Apple in a JP Morgan brokerage account, what JP Morgan does is they put on their own books, Thread, you own 100 shares of Apple. And then JP Morgan has their own books. But JP Morgan is not the end of the line.
Mm-hmm.
There's this company, DTCC, that actually is the shareholder of record at Apple for who owns it. And they consolidate all brokers.
Mm-hmm.
And actually, DTCC uses a subsidiary called Seed and Co.,
Okay.
which owns like 70% of all U.S. equities are owned by a private partnership company called Seed and Co. SEDE. Most people have no idea that this is the case. If you go to Apple's treasuries, books, and records, 70% of their shares are going to be owned by Seed and Co. there's a reason why we only have T plus one settlement in US equities. Because what happens is during that one day, if I sell Apple and I do it on my brokerage and Seed and Co owns it, it takes a day to settle. That day in between, that becomes some sort of a collateral asset
Yeah.
for either the broker dealer or DCCC to use in derivatives and other instruments. And so there's a whole like wall of TradFi that does not want immediate blockchain tokenization settlement of securities. The reason we don't have Apple trading as a token right now is not because the technology. It's because there's billions of dollars being made on the 1 day delay, the float. Um, Overcoming that, Vlad's pushing that. It's the same way that he pushed getting rid of commissions. Like all these brokers were making tons of money off of order flow, and yet they were still charging $20 commission on a trade. And he's like, wait a minute, we can make money just on the order flow. We don't need it. And so what he's doing is he's pushing that industry into tokenization. Once that happens and everything becomes tokenized and the whole paradigm shifts, people are going to start looking a lot more at blockchain assets as legitimate. And like I said, there's going to be these assets that become the rails for all of this. And that's going to be really big. And there'll be winners and losers. And maybe they're winners for 2 years. And then something else comes along that's better. So, I mean, I can't predict all the details. But I think what's happening is that TradFi is realizing that the rails of the financial system, whether it's stable coins, tokenization of securities, whatever it is, it's moving to the blockchain, and you're going to want to be involved in the coins that are involved in this paradigm shift, and that's where there's tons of money, to be made, in my opinion, in the coming months and years.
And that's why we bought Arbitrum. Yes, I love it. That's awesome. Thanks for that take. I'm gonna ask you this last one, and I think I have to let you go, which sucks. We're gonna have to do this again. This might be kind of a loaded question, so feel free to take your time with it. But I just watched your video that you posted, the 15-minute one. Awesome video. There's a lot of sort of coming events in the next 72 hours. I want to ask you specifically on the rate cut side of things. Like, do you think we're going to see rate cuts? And then do you think the market has already priced that in?
I do think we're going to see rate cuts, and I think that and you mentioned that video which I posted a few hours ago, where I said basically I think Powell. There's no reason for him to kind of shoot his load on this meeting. Like he can just basically say, we're going to keep our mind open, but that when August and Jackson Hole comes, then he's going to have to make a call because people are going to be expecting him to telegraph what they're going to do in September. And right now, the market's pricing in like a 65% chance of a rate cut in September. I think it will happen, and there's a number of reasons. One is these central banks get together every 2 months. All the central bank leaders meet in Basel, Switzerland, at the Bank for International Settlement. They have conferences. If the ECB keeps cutting, if the BOE, the Bank of England, keeps cutting, if these major central banks around the world keep lowering and the U.S. doesn't, this interest rate differential stuff starts to actually cause a bunch of havoc. And central bankers don't want that because that can cause like market
Yeah,
delocations, you know. And so I don't think that the Fed wants to be too high of a spread from where the ECB is.
got it.
Um, and you already saw a little bit of a bounce in the dollar this week after the EU agreement, and that was not necessarily positive for equity. So these things are going to force it. The other thing is that, as I said, I don't think these tariffs are really a long-term inflationary threat. I think we have deflationary forces entering the system through AI. This jobs report coming up on Friday probably isn't going to be super strong. It might be like 100,000, not huge. We're seeing continuing claims, not initial jobless claims, but continuing claims stay relatively high. People are taking longer to find jobs. And I think that even Jerome Powell, aside from all the Trump pushing, is going to have to admit we're not seeing blow up inflation from tariffs. The job market is slightly weakening. Our central bank partners are cutting. we've got to make a move here. So I think we're going to see cuts, and I think the market is going to appreciate that, even though I'm actually not someone who thinks that the Federal Reserve really controls equities. I think it's more about uh, supply, demand, money coming into the market, earnings, other forces. But I do think the Fed's going to cut.
I love it, and I love to hear that. Mel Mattison, dude, you're awesome. We might have to bring you back as our our resident macro analyst, and I'll give you some of the degen stuff. But this was sick. I wish we had more time. You're an incredible guy. I'm gonna post all of our clips. I'll post the YouTube link. I have your Twitter shared, but I don't know. Is there any final thoughts or anything you want to leave the audience with as you sign off? You don't have to, but this was awesome.
No, I mean the only thing I would say is like don't believe the hype. Like don't get sucked into a lot of these people who are doom and gloomers. I'm what I call, like boom, man. It's boom, not gloom. And I think that's the way we get out of this mess. That's the way we got out of it after World War II. We inflated assets, we had inflation, we brought down debt to GDP, and I think the US government's got itself into a pickle. And if people think that the answer is going to be austerity or cutting spending, or that's not the answer, it's going to be to try to grow our way out of it. And that's going to create money the way I talked about from the fiscal side, flow into the private side, and it's going to start getting into all of these alternative asset classes in a much bigger way.
It's boom, not gloom, baby. Fuck yeah, dude, you're the man. This was fucking sick. I thanks for the honestly, thanks for the time. You're a Chad, dude. This was lit. I really enjoy this.
Loved it. Thank you.
All right, my brother. We're just getting started, baby. Have a good one. Appreciate you.
Yep.